It's always great to have you with us, Josh. Can I get your take on what Trent was just saying? Just to recap for our viewers, what are the main reasons for the PMI figures coming in below expectations, and how worried are the markets for a recession in the Eurozone?
Yeah, as has been alluded to, a lot of this comes down to this sort of temporary boost that we have been seeing over recent months, where we saw the French economy really propping things up. And if you look deeper, it really was a case of saying, look, what happens when this Olympic boost is stripped out? And now we've seen exactly what happens. We've seen a collapse in terms of the services sector reading in France. That has helped drive the sort of mainstay composite reading lower for the Eurozone. But what we're looking at here is a continuation of a wider trend in terms of, in particular, the deterioration of what has been an economic powerhouse in Germany. Now it turns into the factor that's really driving the region lower, having propped it up for such a long period of time. We had been tracking after the second quarter at a growth rate of 0.3%. This latest set of figures points us towards a growth rate of 0%. And therefore, we're sort of teetering in the potential realms of getting into negative growth territory. And really, we have to start looking towards the ECB and say, does this change anything, or did you expect this anyway?
So what do you think is going to happen with the ECB in terms of interest rate cuts? Is this going to change the strategy?
It's quite difficult because the ECB have started at a lower rate than, say, the likes of the Federal Reserve. They've peaked out in terms of interest rates at a lower rate than the Federal Reserve, and they've started cutting earlier as well. So they really don't want to create this wide disparity between rates in Europe and the rates over in the US, because, quite frankly, if you have money and you're living in Germany, you can just find a risk-free return that is significantly higher over in the US. You'll probably put your money to work over there. So markets currently pricing a 25 basis point cut at each meeting, despite the fact that we've seen all of this weak data. The idea that we're going to see a 50 basis point cut akin to what the Federal Reserve has recently just done seems to be off the table for the time being. That, like I said, probably because we don't necessarily expect to see them try to drive that widening gap between the US. In fact, they probably want to see that narrow.
Okay. And Josh, casting a wider look across Europe, we've talked a little bit about Germany and France, of course. How are the other individual economies in the Eurozone performing?
Well, this is the thing, but by and large, we'll generally look at the Eurozone figures. We might look at some of the big hitters in the likes of Germany in particular, maybe France, but they're not all necessarily in the same position. Spain in particular, 53.5 for their composite reading, well in expansion territory. And really it does highlight the fact that it's not all down to the ECB. The ECB has to set interest rates and monetary policy for the entirety of the group. And for the rest of it, it comes down to decisions made within each country. And certainly when it comes to Germany, the one thing that we have been seeing that's been particularly notable is, number one, weakness within manufacturing across the world, and they're so heavily reliant on it. But also the rebound has really been stifled because a lot of the car makers, it feels, are losing traction as people start to buy EVs. And they're not necessarily buying EVs from Germany. For the most part, it really feels like China and the US are really blazing the trail there, and Germany is struggling to keep up with them.
Okay, many thanks for your thoughts on this today. Joshua Mahony, Chief Market Analyst at Scope Markets.